Hi and Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Atika binti Azhar and today I would like to present about the comparison between Islamic finance and conventional finance. What is Islamic finance? Islamic finance is a type of financing activities that must comply with Sharia Islamic law. The concept that also refer to the investment that are permissible under Sharia. Some of the modes of Islamic finance include mudarabah, wadi'ah, musyarakah, murabahah, and ijarah. Two fundamental principles of Islamic finance are the sharing of profits and loss and the prohibitions of the collections and payment of interest by lenders and investors. So, what is conventional finance? Conventional financing is a home financing scheme offered by financial institutions or banks which are not guaranteed by government agency. Conventional loans are given as per guidelines issued by government-sponsored entities. This ensures that such loans can be sold in the secondary market. It is a transaction based on interest rate for savings surplus or deficit spending units to loan or borrow funds in financial markets. The next is value proposition. A value proposition refers to the value a company promised to deliver a customers should they choose to buy their product. A value proposition is part of a company's overall marketing strategy. The value proposition provides a declaration of intent or a statement that introduces a company's brand to consumers by telling them what the company stands for, how it operates, and why it deserves their business. The value proposition for Islamic finance is Islamic finance aiming on maximize profit based on Sharia and legislation requirement. Financial justice is a requirement that helps Islamic finance products function in a Sharia-compliant way. Profits are shared between bank and depositors with a pre-agreed ratio. For conventional finance aiming on maximize profit only based on regulative requirement. Conventional finance lend money with a predetermined rate of return. Depositors are guaranteed a predetermined rate of return, that is interest. The next is structure for Islamic finance and conventional finance. For the Islamic finance structure, Islamic finance is supposed to be set up is based on the theory of sources and application of funds. There should be a single flow between the deposits and the financing or investment use of the funds. This means there is no distinct function. It is a single function where customer deposits or investment pool is used to fund financing portfolio or deploy into investment instruments where which returns are derived and recognized. Once the returns are determined, these returns are shared between the bank and the customers. This profits-loss sharing structure demands a different way of managing the bank. The next is modus operandi for conventional finance. The first, shareholders give capital. Bank receive customers' deposit and invest. Interests received are distributed. Customers request for loans. Bank borrows interbank funds. Bank lends the funds at an interest rate. The last, customer pays interest plus principal to the bank. Number 4 is operational mechanism. Operational mechanism are the means of control over the pace and direction of an initiative. This is the simplest of still critical of the elements. Operational mechanism for Islamic finance. The first is prohibition of interest and usury in financial dealings. Under Islamic financial system, money is more a medium of exchange and not a factor of production independently. There is no fixed return of capital. However, capitalists can participate in business under profit and loss sharing with or without participation in management of entity. The second is avoidance of gharar, that is uncertainty in business. Gharar refers to entering into a contract in absolute risk or uncertainty about the ultimate result of the contract and obligations of the parties. It is contain a risk, hazard, speculation, uncertain outcome, and unknown future benefits. The third is avoidance of maisir, that is speculation or any game of chance. Maisir refers to easily available will or acquisition of will by chance, whether or not in deprive the other's right. Maisir is prohibited in Holy Quran as well as in Hadith. The fourth is profit and loss sharing. According to this principle, capitalists demanding profit on capital should also participate in loss as well. The last one is financing for only halal business. The list of activities that prohibited in business in which investment for Muslim, such as liquor, pornography, and another are unlawful. The operational mechanism for conventional finance. The first is allowance of interest and usury in financial dealings. Under conventional financial system, money is more a medium of exchange and also a factor of production independently. The second is financing in all business. Activities such as liquor, pornography, adultery, dance clubs, and others are unlawful, hence earning returns through investment in any of these activities is allowed under conventional financial system. The third is profits and loss sharing. There are no fixed rate or interest collected along with this particle of loans. The fourth and last is allowance for investing in bank industry sector. Activities such as pornography, dance clubs, insurance, and others are unlawful. Hence, earning returns through investments in any of these activities is allowed under conventional financial system. The last but not least is instruments offered by Islamic and conventional finance. For the Islamic finance, the first is ijarah, that is rental based. According to the contract, bank purchase an asset and lease to customer for a specific period for a specific rental amount. Ijarah has replaced successfully the facility of leasing under conventional financial system. The second is musyarakah, that is partnership. Any profit acquiring on property is distributed among the co-owners according to agreed ratio. However, loss must be shared in proportion of equity. Musyarakah is used for house financing by IFIs and has replaced successfully conventional mortgage. The third is murabahah, is a cost plus sale contract whereby disclosure of costs to the buyer is necessary. Under murabahah arrangement, customer requests to the Islamic financial institution IFI to purchase an asset for customer and sell on deferred payment. Murabahah has successfully replaced the overdraft and short-term loans facility under conventional finance. The next is mudarabah, is a type of partnership whereby skill and money brought together to conduct business. Profit under mudarabah is shared by the partners as per agreed ratio, while total loss is borne by the capital providers only. In case of mudarabah partnership, one or more of partners must be without capital contribution and act as managers of the business. The last for Islamic finance is istisna. It is a type of sale transaction where the buyer places an order with the seller to manufacture certain asset and the sale is completed upon delivery of the asset to the buyer. It is useful for infrastructure project. For the conventional finance, the first is leasing contract. It's a contract between a lessor and lessee for the hire of a specific asset. The lessor retains the ownership of the asset, but the right to use the asset is given to the lessee for an agreed period of time in return for a series of payments paid by the lessee to the lessor. The second is mortgage loan. It's a home buyer's loan that is not offered or secured by a government entity. The interest rates tend to be higher than those of government-backed mortgages, such as FHA loans. The third is short-term financing. It is to any investment, financial plan, or anything else is lasting for 1 year or less. Short-term investment usually contain less insecurity than long-term investment because market trends are more easily expected for 1 year than any longer period such as T-bills or commercial paper. Next is long-term financing. It is a form of financing that is financed for a period of above than a year. It is provided to those business individuals that are faced of shortage of capital, for example, 20-year mortgage or a 15-year treasury note. The last one is deposit. Conventional banks accept deposits on the basis of loan for all types of deposit account, including term deposit, savings, and current account. Interest-based returns are provided for the saving account and term deposits, whereas current account may offer free banking facilities. In conclusion, Islamic finance has become significant in many Muslim countries. In contrast, interest is forbidden in Islam, and therefore Islamic finance entered into profit-sharing arrangement with both depositors and borrowers. That's all from me. Thank you.